Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 122, and in this episode we are reviewing the performance of the global markets during the 34th week of 2024, and that is from Monday the 19th to Friday the 23rd of August. And without further ado, this is your host Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the Labor Department reported on Wednesday that the U.S. economy created 818,000 fewer jobs than was originally reported in the 12-month period to March 2024. This data was part of the annual benchmark revision to the Nonfarm payrolls number, which showed that the actual growth in jobs was about 30% less than the 2.9 million jobs that was initially reported for the period between April 2023 and March 2024. Even with the revisions, job creation still stood at more than 2 million jobs, but the report could be seen as an indication that the labor market is not as strong as was previously reported. Staying in the United States, the minutes of the Fed's last policy meeting, which was held in July, were released on Wednesday and showed that policymakers had moved closer to a reduction in interest rates, whilst indicating that the probability of a September rate cut had increased significantly. This view was confirmed on Friday when the Federal Reserve Chairman Jerome Powell laid the groundwork for interest rate cuts during his keynote address at the Fed's annual retreat in Jackson Hole, Wyoming. The chairman said that the time had come for policy to adjust, given that the direction of travel was clear, but the timing and pace of rate cuts will depend on incoming data and economic outlook. With markets awaiting direction on monetary policy, traders maintained a 100% chance for at least a 25 basis point rate cut in September and raised the probability for a 50 basis point reduction to about 33%, and this is according to the latest data from the CME's Fed Watch tool. In the U.S. stock market, stocks rose across the board on Friday after the Federal Reserve Chairman indicated that interest rate cuts were on the horizon. Stocks received a boost on Friday after Jerome Powell signaled a reduction in interest rates during his speech at the Jackson Hole Economic Symposium. The Dow Jones Industrial Average increased by about 462 points to 41,175, whilst the Nasdaq Composite advanced by 1.47% to 17,877, and the S&P 500 gained by 1.15% to finish the day at 5,634, which was within striking distance of an all-time high that was set last month. All the three major averages posted a winning week as the Dow surged nearly 1.3%, whilst the Nasdaq added 1.4% and the S&P 500 rose by 1.45% during the past week. In the U.S. bond market, the yield on the 10-year Treasury note fell on Friday as the Federal Reserve Chairman signaled that the central bank will soon begin cutting interest rates. In his speech at the annual Jackson Hole Symposium, the chairman said that the time to adjust policy had come, but the timing and pace of rate cuts will depend on incoming data. Traders are now pricing in a 67.5 chance for a 25 basis point rate cut in September and a 32.5% chance for a deeper rate cut of 50 basis points. In response to the foregoing, the yield on the benchmark 10-year Treasury bond slipped by about 6 basis points to close at 3.8%, whilst the yield on the policy-sensitive 2-year Treasury note pulled back by almost 10 basis points to settle at 3.91%. For your information, bond yields and prices move in opposite directions, and 100 basis points is equivalent to 1 percentage point. In the commodity markets, the price of crude oil rose more than 2% on Friday as the Federal Reserve indicated that it would soon begin cutting interest rates, but for the week, prices fell on the back of slowing demand in China. Despite the ongoing geopolitical tensions in the Middle East, the oil market has become increasingly bearish, mainly due to weakening demand from China as the sale of electric vehicles continues to rise. Lower interest rates tend to stimulate economic growth, which in turn boosts the demand for oil. And in response, the U.S. benchmark West Texas Intermediate was up by $1.82 to close at $74.83 per barrel, whilst the international benchmark Brent crude increased by $1.80 to settle at $79.02 per barrel. However, oil prices were still down for the week, with the U.S. benchmark WTI falling by 2.4%, whilst the global benchmark Brent edged lower by just 0.8%. In the precious metals market, the price of gold rose about 1% as the dollar and treasury yields retreated following the Fed chairman's comments signaling an interest rate cut in September. Following the Fed chairman's speech, both the dollar index and the yield on the 10-year bond declined, making gold more attractive for other currency holders. And as lower interest rates tend to increase the relative appeal of this non-yielding asset, the price of spot gold hit a record high of $2,531 on Tuesday, but corrected slightly to close the week at $2,511 per ounce. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling was relatively stable versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 129.08, and this is compared to 129.20 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a range of between 131 to 133 Kenya shillings. The lowest rate was offered by Stanbic Bank at 131.10, whilst the highest rate was quoted by I&M Bank at 132.30. Meanwhile, the sterling pound was priced at 168.89 and the euro was valued at 143.83. And on the regional front, one Kenya shilling was changing hands for 28.80 Ugandan shillings and 20.96 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.26. The shilling now appears to be relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. And this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we all know by now, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $88 million to $7.40 billion, which is equivalent to 3.8 months of import cover. This level of reserves falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently well funded and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank, and this is in order to regulate the money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by 10 basis points to 12.94%, and this was up from 12.84% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 16.6 billion shillings, down from 28.3 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement stood at 26.7 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 22nd of August, and the central bank received bids totaling 19.1 billion shillings. against an advertised amount of 24 billion shillings, representing a performance rate of about 80%. The central bank ended up accepting 17.1 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 1.5 basis points to average out at 15.79%, whilst the 182-day rate declined by almost 4 basis points to close out at 16.66%, and the 364-day rate dipped marginally and eventually settled at 16.85%. In the primary bond market, the central bank has announced a tap sale for the reopened 17-year infrastructure bond and is looking to tap an additional amount of 15 billion shillings from the domestic market. This tap sale is offered on a first-come, first-served basis and is now open for sale until Thursday, the 29th of August, or upon attainment of the stated quantum, whichever comes first. The 17-year infrastructure bond has 15.7 years left to maturity and a coupon rate at 14.39%. In the international markets, during the week, the yields on Kenya's Eurobonds were on a downward trajectory, with the yield on the 10-year 2018 Eurobond decreasing the most by about 40 basis points as it dropped from 10.8% recorded the previous week to 10.4%. The decline in yields was attributed to improved investor sentiment as the country simmers down following several weeks of street protests that saw the withdrawal of the finance bill for 2024. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 3.4%, whilst the NSE 25, the NASI, and the NSE 10 gained by 3.1%, 2.4%, and 1.3% respectively. This takes a year-to-date performance to gains of 18.4% for the NSE 25, 18.2% for the NSE 10, 14.1% for the NASI, and 12.6% for the NSE 20. The market's performance was driven by gains recorded by large-cap stocks such as Standard Chartered Bank, NCBA Bank, and Kenya Commercial Bank Group, which increased by 10.4%, 7.7%, and 7% flat, respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as Cooperative Bank, East African Breweries, and DTB Bank, which declined by 6.4%, 5.1%, and 0.2%, respectively. On Kenya's national debt, according to the latest data obtained from the central bank, Kenya's national debt as at June 2024 stood at 10.56 trillion shillings, and this was divided between domestic debt, which stood at 5.41 trillion shillings, and foreign external debt that was valued at $39.77 billion, which is equivalent to 5.15 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at two major headlines. The first is the launch of a new payment platform. A new payment platform that will enable Kenyan traders to pay for Chinese goods is set to be launched. The platform referred to as Alipay is a cross-border payment platform that is affiliated with the Chinese e-commerce giant Alibaba. The platform will allow Kenyan traders to pay up to a maximum of $70,000 per transaction. However, the major advantage of this platform is that Kenyan traders will no longer require to buy US dollars, as the platform will facilitate the settlement of transactions in Chinese yuan. Safaricom, through its mobile payment platform M-Pesa, is looking to structure a link-up with Alipay that will enable M-Pesa customers to make payments directly to their trading partners in China. This is a small step in the process of de-dollarization that will eventually allow the yuan to replace the US dollar as the global reserve currency. The second issue is on the new currency printing deal. On Tuesday, the Central Bank of Kenya revealed that it had signed a 5-year currency printing deal with a German currency printing firm that will cost the Kenyan taxpayer a jaw-dropping 14.2 billion shillings. The central bank governor told the Finance and National Planning Committee that the German firm was picked through a classified procurement process in order to avert the risk of a possible stockout in banknotes, which he said would have grave consequences for both the economy and the security of the country. The governor confirmed that the procurement process was conducted in accordance with the Public Procurement and Disposal Act and with the approval of the National Security Council and the Cabinet. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhurij@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, lies are complicated, but the truth is simple. Think about it. Thank you, and God bless.